Good morning to one and all. This is Dr. P. Lavanya, working as Associate Professor in MBA Department in Institute of Aeronautical Engineering, Dundigal, Hyderabad. So today we has to see regarding the break-even analysis. Already we know regarding the theory of break-even analysis, which means no profit or no loss point. Now we'll see what are the formulas and what type of problems we can encounter in this break-even analysis. So first we'll see what will or when I reach the break-even. So already we have said break-even means no profit and no loss point. Means what the investment we invested in the organization actually that will recoup at this point. Means the question is that when we get an answer of starting a business. So that's why it's so crucial to undertake the break-even. Means the startups of every institute or maybe any sort of business, first the people will aim to get their investment back. After that the people will analyze, or after that the people will see that is organization getting profit or loss. So that's why every organization will analyze that when the organization reaches the break-even. So for this, we has to conduct the importance, or we has to integrate the importance of this break-even analysis. So these break-even analysis will help us to determine the fixed cost. Means already we know there are two types of cost, like fixed cost and variable cost. So here the break-even gives importance like a fixed cost, maybe like rent, etc. And the variable cost like which was used per unit, maybe like material, labor or other direct and indirect expenses which comes under the variable cost. So with the help of these two components, that is fixed cost and the variable cost, we appropriately want to see that when the business will becomes a profitability. If I want to see when the organization will get profitability, first I should understand that when organization will get its original investment. Beyond original investment, what I invested in the business, only then we'll get the profit. If investment is not recouped, we are unable to achieve the profits. So that's why every organization wants a break-even point of the business. So as an institute entrepreneur, every business holder want to identify the first break-even, which is very much important for maybe not only the startups, existing and also the expansion organization. So here we can say that what is the point of break-even means is our price. Means when I am reaching to the point of BEP, that is no profit and no loss point, we has to identify that when the prices are too low to our cost or too high to reach your break-even point, which is of reasonable amount of time. Means here we should identify that at the point of break-even, so the organization itself is keeping the prices very low or making the cost very high. So when at that point the organization is reaching break-even, or we should identify. And this break-even is very much essential when we ourselves want to go, that every business want to be sustainable. Once we want to sustain in the external market, only when we are able to attain the profit. So before going for the profit, when our investment comes back, maybe we get a little profits or not at all, we don't get profit also, we can sustain. If investment is not getting and we ourselves was involving into the losses, automatically the organization cannot be sustained in the external environment. So for this reason, every startup or every entrepreneur want to identify what is my break-even point. So here, as we know the definition of the break-even, that it is the volume of activity at which the company's total revenue is equal to the sum of the variable and fixed cost. Means here we can say that BEP is nothing but when the total revenue what the company has been received must and should be equal to the all types of cost, that is fixed and variable. So this break-even could be expressed in units or in dollar sales. Means maybe in case of units, means maybe what type of production units we are having. Based upon that units we can express the BEP, or maybe sometimes we can express maybe in the selling, that is sales volume also we can express the BEP. So it is a point at which way the organization is able to get no profit and no loss point. So this break-even has been given that it is having no profit or no loss point, or we can say where the total cost and selling price was equal. Means the revenue what we are receiving and internal cost in the organization both are equal and form such that the organization at the time of break-even, it won't get profits or it won't get losses. Just it will get the investment what we have invested in the organization. So this point is also known as minimum point of production. Means at this point where organization is able to recover the total cost which they incurred in the production. So that's why the cost recovered by the organization will sometimes call it as a minimum point of production. And now we'll see that what are the components of this break-even analysis. Already we have said in the break-even, total cost in the sense means we have two types of cost. One is the fixed cost plus and another one is variable cost. When those two costs has been compromised, we'll get it as a total cost of a product. So the main components of BEP analysis is also fixed cost and also the variable cost. So already you know the fixed cost means the cost is fixed for certain period of time. So this fixed cost is also called as overhead cost, and these incurred in decision making in order to start the economic activities, or maybe the costs are directly related to the level of production. Means these costs are the fixed and which is required in order to start the any sort of business or any sort of economical activity. Means the total costs are directly related to the level of production. Maybe we can say like sometimes maybe we'll start the production, maybe we require land, buildings, and we want a fixed machineries, equipments. So for that we should keep some amount at a fixed stage. So that fixed cost which is required, maybe paying as a rent, or maybe a purchasing of a land, or maybe purchasing or getting rental equipments like machineries, plant and other equipment. These are all will comes under the fixed cost as they are initiated or starting step for the production of an economic activity. So as these fixed cost itself is including but not a limited one. Means we can't say that this fixed cost is limited to this period, or this fixed cost is limited to the certain time only. So here the fixed cost itself is included but not limited. So like interest, taxes, salaries, rent, depreciation, labor cost, energy cost, means like power, generation of the power. So other which is required to generate the energy. So these are the some of the examples relating to the fixed cost which are fixed in the production. So these costs are maybe irrespective of the level of production. Maybe we produce whatever the level, means activity may be for 10,000 units or 15,000 or 20,000 up to certain limit. The capacity utilization, the fixed costs are fixed irrespective of its production status. So in case of no production is done also, here the fixed cost will be taken place. Maybe like for example, we can say like rent of a factory building. Maybe this month we done the production and we paid the rent to the owner. But maybe next month, due to some unforeseen or unfor things, we doesn't go for production. Maybe it was under our control. We 100% has to pay the rent. So the fixed cost doesn't deals with the level of activity of production. Maybe you produce or you may not produce. This fixed cost must and should be kept. Next one is variable cost. Here the variable cost will call as per unit cost. We can say like variable cost as per unit cost. Means it will varies according to the units what they have been implemented. So variable cost or the cost that will increase or decrease in direct relation to the production volumes. Means how many units we invested, so for that only we will pay. So the main examples of this variable cost are the cost of raw materials, packing cost, fuel and other cost we can directly relate it to the production, consider as a variable cost. Means per unit, maybe like labor, material. When I want to take a labor 5 members, I'll pay only the pay to the 5 members. If I increase to 7 members, automatically the amount will be increases and 7 members pay I has to pay. Means your variable will changes according to the production. So we have a direct relationship with the production relating to this variable cost. So these two are the important components which will comes under the break-even analysis. Now we'll see the marginal cost statement. So in order to solve the problems or in order to identify the organization in case of where the production is able to get a break-even. So first we should have a statement called as marginal cost statement. So in this we can have the important items like sales, variable cost, contribution, fixed cost and profits. So this statement is common in case of cost accounting which was utilized in order to identify the break-even analysis. So in this marginal costing, first we will take like a part A, that is total sales. So what revenue we have earned comes under A. So now we comes to the part B like B, where that sales minus variable cost. So you are able to get sales minus variable cost. You are getting C, means contribution. So in the variable cost, we are having the different items like direct material, direct labor, direct expenses and other variable expenses or the cost like variable administrative expenses and selling and distribution expenses. Means all are paid according to the per unit cost. When all these expenses related or paid for per unit cost, we'll take them as a variable expenses. When we add all these variable expenses and we'll conclude it as a B. So we'll get a contribution. Means in the marginal costing, contribution is very much important. So this contribution we can achieve, that is by sales minus variable cost, that is A minus B. We are able to identify A is the sales of the total revenue what I earn. So with that, when I have been removed the total items relating to the variable cost, we are able to get the contribution. We are able to identify the contribution. So which we will call it like A minus B. Once this contribution has been removed, then we go for decreasing the fixed cost. So next, the fixed cost will be removed. Then if it is a plus, we'll get the profit. If it is a minus, we are getting the losses. Means here the contribution is equal to the break-even. Means no profit, no loss. So where the sales minus variable cost, you are getting the contribution. So the contribution plays an important role in the break-even analysis. With that contribution only, we are able to identify or we are able to take different types of decision in case of marginal costing statement or maybe in the management. We'll take analyzation with the help of this contribution. So this is the formal statement of the marginal costing. So we can get sales minus variable cost as a contribution. And we can also get by using this formula like marginal cost equal to sales minus variable is equal to fixed cost plus profit or loss. Plus or minus profit or loss, we are able to get the marginal cost statement. So these fixed cost or profit or loss, we'll call it like a contribution. So if I want contribution, one I'll make formula like sales minus variable cost, or I can say like contribution is equal to fixed cost plus profit or fixed cost minus loss. So any of the formula we can utilize when you want to find out the contribution, which is very much essential in order to calculate the break-even analysis. So this is a brief description of marginal cost statements which is useful in case of BEP. Next we will see what are the formulas related to the break-even point. So here in the break-even point we are able to calculate as a sales revenue which will minus the cost, where cost is either variable or fixed. So already we know the sales which minuses or which gives the variable cost. So these variable consisting of maybe fixed cost or maybe variable cost. Whatever may be the cost we conclude here is fixed or variable, that we can say like profit is equal to sales minus variable cost minus fixed cost. Or sometimes we can get BEP ways fixed cost plus variable cost. And these equation we can analyze to saying that unit of sale price which will be multiplied with the sales volume in units, where we can minus by unit of variable cost and unit of sales volume minus fixed cost. Means here there is no confirmed formula that one is to be used in break even. So whatever the data we got, based upon the information we got, we can use any of the formula in order to calculate the BEP. So for that some fixed formulas are there, like when you want to calculate per unit, break even when you want to calculate per unit, we can get a formula like fixed cost FC by sales price per unit minus sales price per unit minus variable cost per unit. Means per unit, for every unit what is the break even. So maybe you produce 10,000 units, 20,000 units, 30,000 units, the production units in case of business. So where we are able to identify the break even in units format, that is fixed cost divided by sales per unit minus variable cost per unit. And next when you want to get break even in rupees means amount, then we can use the formula fixed cost by contribution margin per unit. Already we know what is contribution, sales minus variable cost you are getting as a contribution. When fixed cost is divided by this contribution or sales minus marginal cost, then you are able to get the break even in rupees or amount we are able to identify. Sometimes if information is not provided and related to the per unit or maybe the total sales, maybe when we have confused, then we can go for calculation as break even is equal to total fixed cost divided by PV ratio. When total cost is divided by the PV ratio. PV ratio means profit volume ratio. That is total fixed cost divided by profit volume ratio. We also can get the break even. So for that we will see the simple example of BEP analysis, as when you assume when one company has been selling 50 sales price of his product, means selling price SP is 50 for the product and the fixed cost or the contribution margin to determine how many units to sell is 1 million. Yes, sir. So first we'll see the problem. That is, a company has the 50 selling price and its variable cost is 10 rupees. Yes. So when I want to get the contribution, as we know what is contribution? So sales minus variable cost. So 50 rupees minus 10 rupees, that is 40 is the contribution. So we can say that we are able to get the contribution is 40. So simple, we have a formula of that is fixed cost by contribution per unit. When we apply these formula like fixed cost by contribution per unit, maybe what is the fixed cost here given? The company doesn't given the fixed cost. But here when the company sells 1 million units at a rate of 40 and you are able to get the 25,000 units. So whatever we can say here is, if the company sells more units, then it will goes into the profit. If company sells less units, it's going to the loss. So that's why we are able to identify without going for a break-even analysis. We can identify is organization is in a profit mode or maybe in case of DVR loss mode, we can say with the help of the contribution. As we have seen the positive impact, maybe 40 rupees is the contribution, where the total cost may be the fixed or variable cost consisting of 40. So where we can say that if the organization earns above 40, it was able to make the profit. If organization was conducting below 40, then it was able to or went into losses. So already in the above formulas we have seen the PV ratio. So PV ratio means already we have said it is the profit volume ratio. So this PV ratio is one of the important financial metrics which is used to measure the relationship of company's profits with its sales volume. Once how the company's profits will be achieved with the help of the sales volume means two are important. One is profit and another one is what amount the company was selling, that is sales volume of the company. When both are calculated by contribution, then we are able to identify this PV ratio. So where we have the formula of contribution margin by sales revenue into 100. We can say like contribution by sales into 100, we are able to identify the PV ratio. So once the sales revenue is the total amount of the money earned through the profit, and PV ratio is the thing which is expressed in percentage, which will indicate that how much of sales dollar or rupees is available to recover the fixed cost. Means we can say like utilizing this PV ratio, we can able to identify that what amount of the fixed cost was remaining to recover or generate the profit, which indicates that if the larger percentage of the sales volume available to cover the fixed cost and generate the profits. Means when the sales volume is larger and internal variable cost is less, automatically the PV ratio will be more, such that indicates that if PV ratio is more, organization is getting the profits. If PV ratio is very less, organization is going into the losses. So in this way, PV ratio is very much useful for each and every organization. Next, when this PV ratio will accumulate a simple problem saying that if a company is having sales revenue of 1 lakh rupees and variable cost was 60, means here the SP selling price is 1 lakh and variable cost is 60,000 and contribution which is equal to selling price minus variable cost, that is 1 lakh rupees minus 60,000. 1 lakh minus 60, you are able to get 40,000 as the contribution. Means as we have seen here, if the contribution margin is sales minus variable cost, 1 lakh minus 60, you are getting the 40. So when I want PV ratio, then you will get a formula that is contribution by sales into 100. So we got the contribution of 40,000. So which is divided by the sales of 1 lakh. Then we are able to identify into 100. Then you are getting 20%. Means this 20% is the contribution PV ratio in case of this break even. So by identifying the 20% of this PV ratio, we can means that the company has to generate 1 lakh in sales to get the BEP. If 1 lakh is the sales, organization is no profit and no loss will be. And another example where we can say that this PV ratio is much more useful tool for every organization to understand or identify the profitability of the company. It can be used to compare the different products or the services, tracking profitability over the time and to calculate the BEP. Means PV ratio when we are getting, that's a very good, and it also gives the analysis to understand the profitability of the organization, and this PV ratio will compare between the two products or the two institutions in order to calculate the break even. So in this way, another important one in calculation of break even was contribution. So contribution already we have seen in the marginal costing or the BEP. Contribution C plays a very important role and it generates the incremental money for each production units. After deducting the sales from variable cost, we are able to identify the contribution. So contribution indicates the total amount of total cost in the organization. Maybe it is a fixed or variable cost. Means contribution consisting the cost structure of an organization. Maybe it's of fixed or variable. So this contribution is calculated maximum per unit and measurement indicates the particular contribution overall profits of the organization. Means when we are calculating this contribution, so overall profitability of the organization could be achieved. And it also provides a way to the profit potentiality of particular product which was offered by the company, and it shows the portion of sales which helps to company to fix the cost, and any remaining revenue left after recovering the cost is the profit generated. So by the basic or the importance of the contribution, we ourselves are able to show the profit potentiality of a particular product, and also we can see what is the volume or the portion of the sales which helps the company in fixation of cost. And these contribution will also help us in recovering the fixed cost and itself move towards profit generated. So we can say telling that C contribution is equal to revenue where minus variable or total variable cost. So we can identify C as contribution, R is total revenue, and V representing the variable cost, which is expressed in margin, contribution margin, where this is a fraction of total revenue. So in case of this contribution, it could be expressed in contribution margin or maybe divided by the total revenue at the same time. Next, we'll give a small example relating to this contribution. Like if total 10,000 pens are manufactured using a machinery at a variable cost, that is variable cost is 6,000 and total production is 10,000. And the fixed cost where we got is 10,000 rupees. So the total manufacturing cost comes as the per unit cost will be composed like sales minus variable cost, that is 16,000 by the 10, that is contribution per unit is 1.6. So how we are getting this 16,000? In the sense that is fixed cost minus total manufacturing expenses. Yes. So in case of this variable cost is 6 and the fixed cost is 10,000. First we will see the sales minus variable cost. So sales is 10,000 minus variable cost is 6,000, that we are getting the contribution as 4,000 plus this 4,000 plus fixed cost where it is 10,000, then we are getting 14,000 as the contribution. So beyond this we can evaluate like if a pen is sold for 2 rupees per unit. Yes, pen is sold for 2 rupees per unit, where the selling price minus total cost, that is selling price is 2 rupees and where we can see the total cost is 1.6. So 0.4 per unit is the cost of the, that is contribution per the pen. Maybe if I sold 10,000 pens, so 10,000 into 0.4, I'll get 4,000 as an extra profit. So by knowing this contribution, we are able to identify that what is the exact BEP and how much amount we got above BEP could be identified. Next, we'll see what is margin of safety. So margin of safety is also taken from the financial ratios, which measures the amount of the sales which extended the break even. Means this margin of safety is very much utilized to identify that how or what sort of organization was in safe mode in case of profits. Means if I am producing the goods, so by knowing my sales I can say that what is a break even. If you identify the break even, then we can say the amount which we are above break even is margin of safety. Means organization was safe side of that amount which was above break even. So this margin of safety is also one of the financial ratios which indicates the actual profits of the company, where it will be pays or once it requires to pay the fixed and variable cost. So we'll wonder these the amount or the basic figure for threshold amount of this margin of safety is to identify the organization what percentage of profits we are getting, rather than identifying or moving organization towards the losses. So to remove the profitability, the company must and should have the margin of safety. So this says that how much profits or what is the profitability of the, how much profits of the organization, which we'll call like what is the profitability of the organization. And here this is also these margin of safety will reaches the BEP, and it is which we can say like no profit or no loss point. Next we'll see the small example of this margin of safety. As we know, the formula of margin of safety means actual sales minus BEP sales per unit. For example, if selling price per unit is 100 and actual sales is 4 lakhs, then what is the BEP means? Here sales minus variable cost, we are able to get the break as 4 lakhs is the actual sales and break even already calculated and given is 1 lakh. So when you apply the formula actual sales minus BEP sales, yes, divided by per unit, then we can say that actual sales is 4 lakhs and BEP sales is 1 lakh. So which should be divided by per unit, maybe like, yes, so per unit is divided by 100. So we are able to get the 3000 as margin of safety. Means the company is safe position more than BEP in 3000 units. So it indicates that the business is moving 3000 units of sales, which will reach the break-even point. So these are the some of the formulas and with examples to calculate the break-even and preliminary things in the break-even analysis. Thank you.
Like, share and subscribe. Hit the bell icon for more updates.